If you're interested in earning passive income month after month, options is possibly the easiest way to do so, but not any strategy. In this video, we teach you how to do it, and we do so step by step. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City since 2005, and proud to have developed numerous 7 and even 8-figure per year traders. Watch, take notes, and learn from a pro trader on our desk so you can grow your trading account.
Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And because of persistent inflation since the pandemic started 4 years ago, the Federal Reserve has pushed short-term interest rates up to a level that's much higher than our economy has been accustomed to over the last 10 or 15 years. But even at these elevated levels, the most you can expect from a bond or a bank CD is 4 or 5% annually these days. But if you're anything like most investors, you'd really want to be able to produce much more return than that. And on top of that, if you're looking for monthly cash income, it's very difficult to find any kind of investment vehicle that's going to produce a superior cash return and give you monthly cash income. But in this video, we're going to be showing you exactly how to accomplish that through an incredibly easy to learn option strategy. So if that sounds like something you want to hear more about, then stick around, because you're going to be pretty surprised at how easy this is. Now, before we get into the option strategy we'll be teaching you in today's video, if you're brand new to options trading and you don't know much about how options work, we put together a video for you to understand options basics. So if you click on the video appearing on your screen right now, that will lay the groundwork for you to understand the option strategies that we're going to be sharing with you in this video. Then when you're finished, you can come back and watch the rest of the video. What I'd like to do now is to show you how this passive cash producing option strategy would have performed over the last 12 months. And so let's take a look at a price chart of the Qs, the well-known ETF containing a basket of tech stocks representing the NASDAQ 100. And you'll see that on May 19th of last year, 2023, which is the third Friday of that month, a traditional expiration date for options historically, you'll see that on that day, the Qs, which had sold off strongly in 2022, were bouncing in 2023, and by mid-May had reached 336.51. And so let's say that on that day, right around the close, we pulled up an options chain that expired about a month later on the third Friday of the next month, which was June 16th. And we found a put with a strike price right under the closing price, that 336 put, and we went ahead and sold that put for a price of 574. Now, first off, let's understand that when we sell a put option for a price of 574, then we're actually collecting $574, because every options contract, if exercised, would result in the put seller owning 100 shares of stock. And so you multiply the price by 100, and that results in cash income right into your account of $574. Now, since you might be called upon to buy those shares, you're going to need to have at least $33,600 in your account, so that if you're called upon to buy those shares for the strike price of $336, then you'll have the funds to do that. And so that's why this campaign that we're about to share with you is what is known as a cash secured put option strategy technique, because we need cash to secure our obligation to buy the shares that the stock closes below the strike price of the put on the date that it expires. Okay, so now that you've got that cash, that's literally all you have to do, other than wait for the third Friday of June to roll around. And so let's move now to that date. And as you can see, the Q's 2023 rally continued and closed at 367.93 on June 16th. And so what that means is that our put option just expires, worthless, because it's only activated if the stock closed below the 336 strike price, but it closed much higher than that at 367.93, and so the option simply vanishes because it's expired and it can't be activated. And so our profit is the cash we received at the beginning of the trade, that $574. Okay, so you've banked that $574, and so now we can move on to the next trade in the campaign, which is the next month's cash secured put expiring on the third Friday of July 21st. And so we again sell the put at the strike price right below where the stock is trading at 367, and we sell that for $7.24, which of course results in cash inflow of $724. And because of the higher strike price, that would require you to have at least 36.7 in your account to make sure that you have the cash to fulfill your obligation if the put gets assigned. Moving again to July 21st, you can see that the Qs closed at 375.63 that day, and so again the 367 put, much lower than the closing price of the stock, again expires worthless, and we pocket another $724. Okay, so now something interesting happens on the August trade when we enter that day, and that is, as you can see, we sold the 375 put, again, right below the market, and collected $637 for this one, and the trade would have required $37.5, as you can see from the calculation. But on the day this trade closed, you can see that the Qs finally had a pullback and closed at 358.13, which is below that put's strike price. And so we would be assigned 100 shares of the Qs, paying the strike price per share. So we'd be paying $375 a share for those shares. And it's also important to note that we still get to retain the cash that we received for selling that put, the $637 we got. But at this point now, we've got our capital tied up in owning the Q shares, which we anticipated all along could happen. That's why we set aside that capital. But what do we do now to continue to produce monthly income? Well, let's take a look. You see, at this point, in a cash-secured put campaign, once you get assigned the shares, you switch gears, going into a mode of selling calls against those shares, what's known as a covered call, with those shares acting as a sort of collateral. So if the stock closes above the strike price of the call and you're required to sell those shares at the call strike price, then you'll have those shares in your possession. And you'll see that for the September trade, we sold a call this time that was the exact same strike price as the put that just got assigned, the 375, and we sell that call for $1.98, as you can see. And so the reason that we sell it at the exact strike price is that if the stock rallies and closes above 375 and the shares are called away by the one we sold the call to, then we'll have been paid exactly what we paid for them when we are assigned the shares in the first place, $375 per share. And so we'll experience neither a realized gain nor a realized loss. We'll just break even on those shares, and that's what we actually want to do. This approach to selling calls against shares we were assigned in a cash-secured puts campaign is known as the wheel strategy, and you'll see a little bit later exactly why it's called that. Okay, so at this point, let's start compiling a scorecard of the trades we've been doing so you'll begin to see the totality of the campaign. And as you can see, by August, we've been collecting cash each month, but now we own 100 shares of the Qs as of the August expiration. And so we've sold that first call against the shares we own. Now let's move to the day the September trade expires. As you can see, the stock closed at 370.81, which is still below the call's 375 strike price, so that call expires worthless. And the $198 of cash originally received for that call, we just banked that. So we add that to our scorecard and go ahead and sell another call at the same strike price, the 375 call, so that if the market rallies and the shares get called away, we'll break even on those shares. And so moving to the day this new call expires, you can see the stock closed again well below 375, and so the option just expired worthless as well, and so we pocket another $618 for the October trade. And so yet again we sell a 375 call against the shares for November, and this time we finally get a bounce in the Qs, closing at 386.04, resulting in our shares finally being called away for the exact same price they were assigned to us initially. And so that's just a break-even transaction, and we just booked the call premium we received. And so what we'll do at this stage with the shares gone is to simply resume our put selling program each month, just like we started. And so now you can see why this is called the wheel strategy. We sell puts until the puts get assigned, then we move into selling calls against those assigned shares until those shares are called away, at which point we resume selling puts. So we've come full circle, just like a wheel. And so as it turns out, in each of the next 4 months, December, January, February, and March of 2024, the Qs rallied, resulting in all of those monthly puts expiring worthless. Now, the April trade was a different story as we sold the 432 put, but the Qs sold off to 414.65, and therefore the shares were again assigned to us at a price of 432, and we booked the put premium of $805. Okay, now, so as you should now understand, we're going to implement the call selling process again, as we did earlier in the campaign. But as you can see, the Qs rallied again, and by the May expiration, the stock was trading at 451.76, resulting in the shares again being called away and are pocketing the call premium. And so when we calculate the full 12-month campaign profit, as you can see, we collected a total of $6,589, which on the most capital we used during the campaign, which was the 43.2 we needed for the April put, the conservative return on this campaign comes out to 15.25%, and the average monthly cash flow was $549, far more than you could have gotten investing that 43.2 in a bond. And the truth is that we're actually understating the returns a little bit, because while you're selling puts, you aren't actually using the cash you've set aside for the possibility of being assigned the shares. And so at today's money market rates, you could earn an additional 5.13% on your unused cash funds while you're waiting for the puts to be assigned 1 month. And so over the period we studied in this video, you could tack on another few points of return on top of that, given that we only owned shares in 4 of the 12 months of the campaign, if you think about it. And so what I'd like you to take away from today's video is that there's an alternative to boring money market rates and tiny bond returns, which can often be achieved by implementing the wheel strategy that we've taught you in this video. The cash you can collect selling puts on solid stocks and then selling calls if you're assigned shares is a great way to earn cash on your investable assets, provided the stock you're crafting your campaign around has strong long-term prospects. Given that the Qs represent largely a basket of tech stocks, I think most people would consider the long-term prospect of the Qs to be bright.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.